The Indonesian rupee, for one instance, is continue to attract a lot of investors simply because it's a high-yielding currency.
Stephen, welcome to Dukascopy TV. It's a pleasure to receive you.
Thanks for having me, Natalie.
No problem at all. Now, we're going to be doing a little bit of an APAC currency wrap today, starting with our domestic currency, the Australian dollar. Now, CBA have been the first bank to cut their forecast, seeing the Aussie dollar buying 73 US cents by year end versus a much higher previous forecast. How does this match up with where OANDA sees the Australian dollar going? And also, how is RBA rhetoric really shaping sort of currency forecasts around the local currency at present?
Okay, a few good questions. As far as forecasts, it's quite volatile markets right now. So, the spread of the forecasts out there are quite a wide range. We're seeing all the way from under 70 cents all the way up to 76 cents by year end. However, we're looking more along the lines of commodity prices, and I think that's primarily what's going to be driving the Aussie dollar. Right now, we're seeing commodity prices, hit their ceilings. Right now, we're seeing some significant highs in iron ore. We're seeing a rebound in the oil market. So this is all playing into positive Aussie sentiment. Getting back to your question right now about the RBA, well, obviously they came out with the minutes yesterday, and the minutes were indicating that it was a really tough decision on this recent rate cut. But obviously the drop in inflation really played their hand, and that's really what drove them to cut the rates. However, on the other side, it was a tight decision. So perhaps the escalation of the easing cycle might not be as aggressive as what the market had been pricing in, and that could also stop the Aussie dollar from dropping off significantly. Overall, however, we believe that the high commodity prices are not sustainable. We'd be looking for commodity prices to drop given the global outlook, global demand outlook. So I would assume that based on that outlook alone, that the Aussie dollar would be trading closer to the 73 cents level as opposed to the 76 cents level by year end.
Now moving into the Asia region and taking a look particularly at the Japanese yen. Now, yen intervention remains an option for the Bank of Japan in the face of what is a broadly stronger currency. But do you really see the central bank sort of beginning to engage in that currency war?
I don't think the dollar yen has got to a point where intervention is really on the Bank of Japan's radar. I think they've been ratcheting up the rhetoric because of the quick drop that we had on dollar yen last month, and I think that was worrisome, and it looked like that was going to continue on down to the 105 level, or even perhaps more. And I think they were just shooting warning signs out to the market, saying, "Listen, we are going to intervene." However, if you look at the warnings that have been sent out by the U.S. Treasury, they're adamant against any type of aggressive intervention that could be conceived as manipulating the markets or what they're referring to as competitive devaluation. So I think central bankers are really focused on that right now, and there is a reluctancy in the market to use monetary policy to effectively adjust the course of your domestic currency.
Well, one area where we really are seeing high levels of intervention is with the Chinese yuan, and already that's having the impact of really reducing that take-up of RMB denominated assets. Obviously, we're immediately seeing an immediate domestic effect, but what impact is this intervention having on the broader FX market also?
I think right now the PBOC is in a happy spot simply because the U.S. has kept the interest rates rather accommodative, and that's taken a lot of pressure on capital outflows from China. So the yuan has actually been trading at a very stable level, which should in fact give investors some semblance of confidence. But the issue with China is the lack of transparency, and that seems to always come to the forefront, and we continue to see that a reluctance of investors moving into China because they really doubt that the economic data and what the policies are truthful. There's a big debate about that, and that's going to be an ongoing issue as China moves forward.
Lastly then, Stephen, taking a look at sort of the broader APAC currency space, what are some of your buy sells at present?
Well, it's always a wild card to look at the dollar Asian basket against the U.S. dollar because the unpredictable nature of the Feds could raise rates and all of them could weaken off. But if you look at them as an individual currencies between each other, there's some standouts. I mean, the Indonesian rupee, for one instance, is continue to attract a lot of investors simply because it's a high-yielding currency, and the government's actually introduced some good fiscal policies this year, which should attract should attract some benefits to the country. We look at countries like Malaysia that are connected very strongly to the oil markets. That currency looks like, although it's weakening right now, it looks like it could perhaps go on a strengthening tangent again. Whereas we have countries like the Singapore dollar that are really dependent on the export markets, and given the global headwinds of the drop in economic activity globally, that's going to face considerable headwinds through 2016. So it's a mixed basket. We have some currencies that should accelerate, whereas we have other currencies that'll probably remain on a trade off its back foot through 2016.
Stephen, many thanks for your insight today.
Great, thanks for having me on.
Stephen Innes there providing his insight from OANDA. That is all we've got time for right now. I'm Natalie MacDonald. You've been watching Sydney Direct on Dukascopy TV. Goodbye for now.